Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could in turn impact the positioning of our schemes. 10-year benchmark UST and 10-year UK gilt softened by 3 basis points each, whereas yields of 10-year German Bund and 10-year Japan bonds hardened by 9 basis points and 15 basis points respectively during the month of January 2025. U.S. Federal Reserve kept rates constant in its Federal Open Market Committee meeting held in the last week of January 2025. Fed Chair Jerome Powell's speech aptly summarizes the current U.S. economic scenario. Recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have remained strong, and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. In recent months, there has been a lack of further progress towards the committee's 2% inflation objective. Consumer Price Index, year-on-year, for December 2024 printed at 2.9% versus 2.7% in November 2024, well above the 2% target. Even Core Consumer Price Index, year-on-year, though printed lower at 3.2% versus 3.3% in November 2024, still remains elevated. On the labor front, job openings and labor turnover survey, job openings for November 2024 was stronger than anticipated, 8.098 million versus 7.73 million expected, and unemployment rate for December 2024 fell to 4.1% versus expectations of 4.2% compared to 4.2% in November 2024. U.S. Treasury yields witnessed a lot of volatility during the month of January 2025, with the 10-year benchmark U.S. Treasury yield moving from 4.57% up to 4.79%, 14th January 2025, and back to 4.54% by the end of the month. This volatility was caused due to the uncertain macroeconomic environment caused by changing policies and expectations. During the month, January 2025, speeches given by Fed official members maintained their cautious stance while highlighting the sticky inflation and the uncertain environment. On the other hand, a week before the Federal Open Market Committee meet, U.S. President Donald Trump said he demands the Federal Reserve to cut rates. It is important to note the 30-year U.S. Treasury yields have hardened from 4.36% at the end of November 2024 to just shy of 5%, 4.97%, by the mid of January 2025. It retracted back to 4.76% by the end of the month, January 2025. Fed Powell mentioned longer-term rates have gone up not because of expectations of policy or inflation, but because of a Trump premium story. Eurozone, European Central Bank decided to cut interest rates further by 25 basis points in its January 2025 policy, and policymakers guided for a further reduction in March as concerns over lackluster economic growth supersede worries about persistent inflation. It was the 5th European Central Bank rate cut since June 2024, driven by arguments that the biggest inflation surge in generations is nearly defeated and the flagging economy needs relief. The Eurozone economy stagnated in the last quarter of calendar year 2024, with quarter-on-quarter GDP falling to 0% from 0.4% in the third quarter of calendar year 2024. UK. Similar to Eurozone, UK economy is slowing down with year-on-year gross domestic product at 1% for November 2024, compared to 1.1% in October 2024, and Manufacturing Purchasing Managers Index contracting at 47 for December 2024 versus 48 for November 2024. Consumer Price Index cooled to 2.5% in December 2024, down from 2.6% in November 2024. Unemployment rate increased to 4.4% for November 2024, from 4.3% for October 2024. A 25 basis point rate cut is expected in the upcoming Bank of England meeting. China. People's Bank of China has been cutting its loan prime rate to promote growth and healthy inflation in the country. With the recent growth stimulus measures, gross domestic product has moderated to 5.4% year-on-year in the fourth quarter of 2024 from 4.6% in quarter 3 2024. Inflation, on the other hand, remained stagnant in December 2024 compared to a deflation of 0.6% in November 2024. Japan. In January 2025, Bank of Japan hiked its interest rates by 0.25% to 0.5%, the highest level since the 2008 global financial crisis. Japan's governor, Kazuo Ueda, has discarded his predecessor's radical stimulus policy and had raised rates to 0.25% in July 2024. Bank of Japan policymakers have repeatedly said the central bank will keep raising rates if Japan makes progress in achieving a cycle in which rising inflation boosts wages and lifts consumption, thereby allowing firms to continue passing on higher costs. Japanese yen has appreciated by approximately 1.3% during the month of January 2025, from 157.25 to 155.18 against the US dollar. The 10-year G-Sec traded in a band of 6.68% to 6.84% and closed at 6.69% in January 2025, vis-à-vis 6.76% in December 2024. In line with 10-year benchmark U.S. Treasury yields, Indian 10-year yields also increased in the first half of the month and tapered off in the latter half. Post the budget, the 10-year softened further by 3 basis points due to the decline in fiscal deficit along with a marginal decline in the net government borrowing. The gross borrowing was higher than expected, limiting the slide in the 10-year Indian benchmark yields. At primary auctions, yields of 91-day T-bill hardened by 1 basis point, whereas yields on 182-day T-bill and 364-day T-bill softened by approximately 3 basis points and 6 basis points respectively. Consumer Price Index inflation moderated to 5.22% in December 2024 from 5.48% in November 2024. The reading also came in lower than the Bloomberg's median poll of 5.30%. Average inflation for Q3 FY25 stood at 5.63%, 7 basis points lower than RBI's estimate of 5.70%. Food and beverages inflation moderated to 7.69% in December 2024 from 8.20% in November 2024. Key components including cereals and products, vegetables and pulses, and products noted lower inflation in December 2024 compared to November 2024. In December 2024, the Consumer Price Index ex-food and beverages stood below 4.0% at 2.95% for the 16th consecutive month. Core inflation declined slightly to 3.58% in December 2024 from 3.64% in November 2024. Inflation scenario continues to remain uncertain with persistent price pressures from the food basket. The RBI has revised inflation projection for FY 2025 higher to 4.8% from 4.5% earlier. As per RBI projection, CPI inflation is expected to reach the target of 4.0% only by quarter 2 fiscal year 2026. During the last month, US dollar portrayed continued strength, however, noted marginal depreciation of 0.11% due to a sharp appreciation in Japanese yen as the Bank of Japan, BOJ, delivered a rate hike of 25 basis points. Since Donald Trump's victory in the U.S. presidential elections, USD has shown greater strength over all the key global economies. US and Japan have been on the opposite sides of the monetary policies, keeping the global currency market volatile. Japan is expected to raise interest rates further in the coming months in view to curb inflation and to support Japanese yen. Indian rupee continued to remain under pressure and depreciated by 1.18% in January 2025. Indian rupee traded in the range of rupees 85.65 to 86.65 per US dollar during the month and ended the month at rupees 86.62 per US dollar. Foreign portfolio investments were net sellers in equity markets with an outflow of US $9.0 billion, while debt markets observed a marginal inflow of US $52 million in January 2025. Due to excessive pressure on Indian rupee, Forex reserves have been on a declining trend. Forex reserves stood at USD $629.6 billion as on January 24, 2025 compared to US $644.4 billion a month ago, noting a decline of US $14.8 billion during the month of January 2025. Liquidity conditions during January 2025 continued to remain tight. Despite the RBI releasing liquidity amounting to rupees 1.16 lakh crore through credit reserve ratio cut of 50 basis points in two tranches of 25 basis points on December 14, 2024 and December 28, 2024, systemic liquidity remained in deficit. Also, during the month, the RBI announced an array of other measures including open market operations purchases, US dollar per Indian rupee buy-sell swap, and 56-day variable rate repo auctions in a move to further support liquidity. Banking system noted a higher daily average deficit of rupees 201,447 crore in January 2025 compared to a daily average deficit of rupees 64,769 crore in December 2024. The daily average of weighted average call rate stood at 6.61%, marginally lower than the previous month's, December 2024, average of 6.65%. Bank deposit growth stood at 10.8% as on January 10, 2025, while credit growth stood at 11.5%. On a FYTD basis, bank credit has grown by 8.3% compared to a deposit growth of 8.2% in the same period. Growth in US remains solid with private consumption still strong, allowing the Fed to maintain status quo on its policy rates and buy time to see the effects of Trump's policies. In contrast, a weakening Eurozone economy resulted in European Central Bank cutting rates during the month. UK is likely to follow suit with its faltering growth. A softening momentum was also seen in China's PMI surveys, manufacturing PMI. The effects of Trump's tariff measures need to be monitored closely. It remains to be seen whether the steps result in retaliation by affected countries leading to trade wars or whether Trump is forced to reconsider the measures. The effect on inflation in the short term. The medium-term growth outlook will directly impact global yields and their respective currencies. An important factor to watch out for is whether the tariffs will lead to a spike in US inflation or will US growth pick up as intended at the expense of other countries. US yields are likely to remain elevated, reflecting concerns about inflation, fiscal policy, and the likely delay in FOMC's easing cycle. Though growth concerns may weigh on the yields, USD is also likely to remain strong as the rate divergence is expected to widen, except Japan. Developments in China as well as Japan over the medium term are also important. China's sluggish economy is expected to have support both from monetary and fiscal side to get its economy back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. Japan, on the other hand, shall be on a rate hike journey, and the resultant impact of unwinding of yen carry trades on various asset classes would be another factor to monitor. GDP growth has printed substantially lower than market consensus. While domestic inflation is susceptible to volatility due to food components, CPI has also shown signs of moderation. Hence, a rate cut in the upcoming Monetary Policy Committee meeting is widely expected. Further, the recent liquidity measures announced by RBI seems to pave way for the upcoming policy in order to effectively implement its rate cut. Foreign capital movement away from Indian markets to better valued markets like China and strong dollar index have kept the Indian rupee under pressure. Further, we are significantly overvalued compared to other emerging market currencies, and the new governor, Sanjay Malhotra, seems to have signaled his willingness to allow the rupee to move more freely, in tandem with peers, while still intervening to curb excessive moves. India's budget continued on its path of fiscal consolidation, with fiscal deficit pegged at 4.4% of gross domestic product in FY26. 4.9% was revised to 4.8% for FY25. This shows the intent to improve the debt to gross domestic product going forward, which is positive for the medium-term growth trajectory. Centre's net market borrowing for FY26 is pegged lower at Indian rupee 11.5 trillion, FY25 Indian rupee 11.6 trillion. But gross borrowing number is on the higher side at Indian rupee 14.8 trillion, FY 2025 Indian rupee 14 trillion, given higher repayments. While inflation remains higher than target, though now within the tolerance band, growth concerns and guidance from Monetary Policy Committee may move the yield curve lower. Further, Indian government bonds inclusion in the global indices and the proposed liquidity coverage ratio norms by the RBI will keep the demand-supply dynamics favorable. We maintain a bullish bias and expect the 10-year Indian yields to structurally move lower, though may remain range-bound in the near term.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.